Welcome to Westbrook's COVID Conversations. Joining me today is Manoj Soni. Manoj is the Chief Investment Officer of UK-based Capricorn Private Investments. Capricorn is a private investment office and part of the larger Capricorn Group, a UK and SA-based private equity investor. Manoj has a long background in investments, first entering the industry in the midst of the dot-com bubble in 2000 and has been investing into private equity and the larger markets ever since. Manoj, it's great to have you.
Thank you, Dino. Another crisis, hey? They keep coming.
Manoj, I'd love to chat today.
I had some practice now. Had some practice.
Well, I'd like to hear a little bit about it today, and I think that's exactly what I'd like to cover, is just a little bit of sort of your thoughts on the industry as a whole, where we're at the moment and where we're going. But maybe before we start, can you just tell us a little bit more around Capricorn?
Yeah, so Capricorn Private Investments, as you mentioned, is part of the broader Capricorn Group, which is a direct investor in private businesses in the UK and South Africa. We were set up to manage internal wealth and then rolled that out to friends and family and now further beyond a couple of years ago. And so typically we work with entrepreneurs, wealthy families, smaller institutions, usually with above $10 to $20 million of investable assets. And we'll either manage a portion of it or we'll manage all of it. Essentially, we provide kind of an outsourced family office for many of these people, or an outsourced investment advisor for many of our clients. We work with a very small number of families and institutions, so they get pretty tailored advice. There's no models, so everything is done in accordance with their objectives.
So Manoj, I mean, you've got unique, I suppose, insights into the private markets, the listed markets, the UK market, the SA market, and surrounds. Maybe to start, where do you see the world today in the context of what's going on with COVID?
Yeah, and anything I say can be ridden roughshod over by change in circumstances. If there's like a vaccine that comes out tomorrow or something like that. But look, I do think that COVID-19, it's not going to be a surprise to anyone, has accelerated change across a number of industries, including our own. And it's going to change the way we work and the way we do things, and we do think that has implications for portfolio management. I think in terms of sort of where we are right now, the biggest question I get asked is, why are the public markets doing what they're doing? And I've sort of put together a little framework for people, very simplistic framework, just to help contextualize what's going on today. I mean, we could talk a little bit about that, and then we can talk about what Capricorn is doing, on the way forwards. Does that make sense?
Perfect.
So if I can maybe share a screen with you here, which just helps me talk through, how we see things today. As I say to investors, markets, you have to disassociate the stock market from the economy. There are many things that move the stock market, on a day-to-day, week-to-week basis, and it's not just how the economy is doing. There's also many other things that are driving it right now, and I've put a list of them. There's probably more, or maybe and each one of these factors on the left-hand side of the page matter more one day than the next. But just to give an overall framework of how we're thinking about the world, the items on the left are the things that we think are most important right now, and the red box is effectively a slider, and we sort of show you where we think whether these factors are positive, neutral, negative on asset markets, whether it's public or private. This is just a general high-level picture. Sure. And then you can see here, we're running through very quickly, valuations, equity market valuations, extremely high, which caps the upside. But on the positive side, many investors are sitting in cash. Many investors have exited the markets. There's also a lot of stimulus being provided by central banks and governments all around the world, particularly in the developed markets, which is acting as a support mechanism, rightly or wrongly. We're also tracking things such as medical breakthroughs on the vaccines and treatments. We think a vaccine is 1 or 2 years away. The fastest ever vaccine developed was 5 years. So if you get it to 2 years, you've done an amazing job. Maybe there are some treatments that come along that alleviate the symptoms and think this is important, because the key to getting economies back on track is to remove the fear that people have of catching the disease and to eliminate the requirement for social distancing. You don't need a vaccine to do that per se. You could get there if you have an effective treatment that reduces your probability of going into hospital by 50 or 70%, and suddenly the disease doesn't seem quite so scary because you can get a drug that will help you be okay. We're also tracking the success of countries' ability to keep the virus under control. That's another thing that allows social distancing restrictions to be lifted, which is really the key. And within Europe, anyway, those countries that have had successful lockdowns and are emerging from them, like Germany, France, Italy, Spain, haven't seen any significant second outbreak. The US is a different picture. They haven't done a great job of actually removing the virus from society. And so they're going to have to end up, I think, living with it a lot more. And you're going to see a lot more cases there, which I think is net a negative. So that's kind of the picture of the way we see things. And you can see the red at the top, our slider sits on neutral. Now, why is it neutral? It's largely because some factors are bearish and some factors are bullish. I think we're probably unlikely to see those market lows in March tested again, just because of, one, the stimulus, the liquidity, and also just a general improvement in economic outlook from a very low base.
So Manoj, maybe just a question on that. I mean, we've seen in the US market almost all of the losses in the year eliminated, and the market's strong over there. Your sliders show neutral. The market seems to be a little bit more positive based on performance. How do you reconcile the two?
Yeah, I think the S&P is slightly the wrong benchmark to look at, because 25% of it is made up of technology shares, 15% of it is made up of healthcare, and then another sort of set of defensive sectors, including telecoms, utilities, and consumer staples. Got to take that share of the index up to 60%. And when you look at those sectors, they're not really experiencing significant earnings declines at this time, nor are they forecast to. In fact, some of the companies in there will have earnings growth. And so it's sort of the wrong benchmark to look at. And when you think of it in that way, it kind of makes sense that there has been a V shape in the stock market. Other markets around the world haven't done as well, such as the FTSE, various emerging market indices, various European stock market indices, and smaller cap companies that are more representative of what goes on in the economy, which is actually mostly made up of smaller unlisted enterprises, which are generally suffering. Those markets are down still 10, 15, 20%. And so I think that they're a little bit more representative. But the US market is a little bit different because of the makeup of that index, and particularly the high share of market cap that is attributed to the 5 very large global tech giants who've actually, gained more market share as a result of COVID-19.
It's interesting. Manoj, another question. I mean, you're obviously plugged into the world of high net worths and ultra high net worths in the UK. Where are their heads at the moment?
Yeah. Most are still, I think, fairly worried about the world, and are generally sort of preferring to remain in cash. We have encouraged our clients to hold the course, which most of them have done, if not all of them, in some way, shape, or form. And so they've benefited from this recovery. We've actually, in the last few weeks, just reduced some risk as the markets have rebounded. As you know, while we have a neutral outlook, we think as I said, the upside is somewhat capped. And so we've preferred to just build a little bit of liquidity to really allocate to some of the future opportunities that are coming up, and many of our families are will be willing participants in those. I mean, I have another. I think there is a sort of really, we see the world in four key themes. Number one is so talking about the just continuing on from the point about technology is what we call a trend acceleration theme. So what COVID-19 has done, particularly in the developed world, is it's led to a what companies thought would happen in 5 years or 10 years has happened in 12 weeks. Much bigger online adoption, much bigger use of e-commerce, much bigger use of online shopping. There'll be more stay at home. And so that we think will support software as a service, internet infrastructure, data centers, logistics as well within the real estate world. So gaming stocks as well, streaming stocks. So while those stock prices have gone up a lot, we actually think there's probably more to come in those areas. So that is something that we see continuing going forward, and actually being a beneficiary of the after effects of COVID-19. Maybe if there's a vaccine, you might see a little bit of reversal, but the longer it takes for a vaccine to come, the more entrenched these trends will become, and the harder they will be to then turn back, and you'll see the reverse behavior again. I think the days of people commuting an hour to go into an office to sit at a computer and use a phone are just long gone. It just doesn't make any sense anymore for anyone. Then I think the other trend that we see is, or risk really, rather than trend, risk, is one of reflation. Clearly, central bank balance sheets have expanded massively in the last month or two. And how this debt gets paid is anyone's guess. We think that more likely there'll be a monetization that happens in the future, which leads to inflation down the road. Probably not right now, just because of strong deflationary impacts from higher unemployment, but certainly down the road, portfolios should be built to buy some inflation protection down the line. That could be a real risk where clients see their wealth eroded. And so for that, we like gold mining stocks should be included in portfolios going forward. The other item that we see is, while there has been a lot of stimulus been made available, we still think that only really the strongest balance sheets will survive. And so ultimately, we're going to skew our portfolios to quality companies that have low debt, low leverage, strong brands, a proper moat to their business within the world of equities. And within the world of debt, we'd be focusing on higher quality opportunities. For example, in the world of private debt, which we're actively allocating to, we've reduced our return expectations, and instead of shooting for high double-digit returns, we'll go for high single-digit returns, but with much more security. Try and seek a hard asset, for example, a low loan-to-value, such that if there are markdowns on the collateral, we still have plenty of headroom before we're impacted. I mean, that's an area of strong interest for us in the coming months. We think that opportunity set will improve. So I call that sort of a focus on quality. And then I think the fourth theme that's going to become important and is an active area of research for us is exploiting distress when it comes about. And there are really two types of of distress. One is people who need to get out of positions. So in 2009, there was a great opportunity to buy secondary interests in hedge funds and private equity funds where limited partners were seeking to exit their positions to generate liquidity. And we think that'll be an opportunity that presents itself in the coming weeks and months, particularly as various government schemes maybe get rolled back and the economy goes into a slightly more difficult phase. And so that's one opportunity that we think comes later this year, early next year. And then we also think there'll be more defaults to come. I mean, so far in America, there's only been one major corporate default, which is Hertz. But we think there'll be more to come there. And also within, I mentioned that in the property sector, we think there's an excess of supply now in property, and that whole sector will become repriced. And so there may be some good opportunities, we think, in the property debt space where one actually ends up becoming an owner. And if you can reposition the asset into something more useful for the post-COVID-19 environment, that's a potentially very good opportunity. So we do think within corporate and real estate, there'll be some great distressed opportunities in 2021. So that, again, those are sort of the four themes that we're following and repositioning client portfolios to. And the other area that we're also have always been allocating to, but we'll be doing more, is just genuinely uncorrelated investments. So, Capricorn has a long history in insurance through ownership of various insurance businesses. Insurance-linked securities have been a staple of our portfolios and have performed well. And whatever happens with COVID-19 or the wider economy, it doesn't really affect what happens to those investments. And so they're a strong area of interest for us.
I think that's been hugely helpful. I would have loved to have had a little bit more time, but unfortunately that's all the time we've got available today. But some interesting comments specifically around sort of the way forward, and looking at defensive businesses that are positioned well into COVID, and then unique alternatives, including the likes of private debt and distressed opportunities in this context. Manoj, thank you so much for the time.
You're welcome, Dino. Thank you for the opportunity.
That's Manoj Soni. Manoj is the Chief Investment Officer at Capricorn Private Investments in the UK.